All right, traders, hopefully your 2023 is off to a very profitable start. This video, we are going to review the importance of understanding ranges. We're going to start with the daily ranges, and this is how you incorporate data into your trading. The importance of ranges. This video will cover the daily range. So what we do is we pull up a data sheet. This is the gold data for January 2023. So we're going to keep every day, we're going to post the data ranges for gold so that when we start our trading day, we can look at the previous day trends. We'll look at the previous five-day trend. We may go longer than 5 days, but we want to see what the price has been doing the previous 5 days. So what we do is we'll come to the chart and we'll say this day on the 11th went almost 2,000 pips. This day on the 10th, 1,300 pips. This day on the 9th, 1,700 pips. And then we get into some larger days. That's almost 4,000 there. That's 3,400 there. And then we have another 3,000, 2,900 pip day right there. So we want to know the trending days. And then you also can come back here to these larger range days and see what the range for these days were also. All right, that's 3,500. That's 3,500. And then we had a smaller day of consolidation here, which was a 1,200 day, and the day of consolidation here, 1,200 day. So how do we use daily ranges? How do we use data to our advantage during the trading day? Every single day we mark off monthly highs, monthly lows, weekly highs, weekly lows, weekly high, weekly low, monthly high, monthly low, monthly open, monthly close, weekly open, weekly close. So we already have our levels of support and resistance drawn on our charts. So during the trading day, we can know these daily averages, and they will already be printed out for us each and every day. We write down the daily average. So when we start our next day, we can look at this data, and then we can know, all right, we're trending around the 3,000 pip range for the 12th through the 9th. We see some 3,000s here, 4,000 here, 2,800 here. So the 3,000 range is in the high average for the daily range. And then we see some smaller consolidation days here in the 1,500. That's still 2,000. Now on the 12th, we have 2,800. So when we begin the trading day with our levels already put on the chart, now this is an uptrend. What would we expect in an uptrend? We would expect the price to start reaching into monthly supply and demand, support and resistance areas, and then we would expect the price to retrace and then continue in the trend. Now, gold retracements on the day are usually more than 1,000 pips. Here's the example for the trading day, which we gave you a live signal on this trade. This retracement went 2,800 pips up and 2,800 pips down. That is a great move for intraday and swing traders. Now, right now, towards the end of the New York session, we are getting some sell signals here on the 3, which you could have placed a trade here for 200. And then now the price most likely may range within the next couple hours, so that the Asian session Uh, they're reconciling books right now, and then the Asian session is going to start here in about 4 hours. So the way that we use daily ranges is once price has moved 3,000 pips and has entered into the pre-drawn monthly supply and monthly resistance, then we can expect price to retrace. Why? Because every single month and every single day there are buy and sell orders for daily moves. The New York session opens at a certain time of day. The London session opens at a certain time of day. So that we know each and every day there's going to be a time where the day is going to have a daily move. So how does that give you an advantage? That gives you an advantage to know during the trading day, on this day, when we saw the day moving up past 2,000 or 2,500, so this day started here at 2,300, the 2,300 hour here, and then the day moved up in pips. 5 o'clock hour, we had a push for the Asian session. Then we had a retrace, which we traded. We had a live trade here. That would have booked you 500 pips. And then the day pushed up from the Asian New York, Asian London session. The day pushed up 2,000 pips. So that's a 2,100 pip move up during the trading day, coming into a 0-0 order block of supply, sell orders, institutional sell orders during the New York session. Now we did have moves, we did have news here, but when you study the news, price will only go to where the orders are. So when you study news trading and you draw all of these levels on your chart, price will only go as far as the orders allow them to go. So if your levels are drawn correctly, then you can enter into trades based on this area, based on this order block. So again, how does knowing daily ranges give you a benefit for swing trading and intraday swing trading? We know that there is an order block here because we have drawn it on the chart. Every month when gold enters into a monthly area of supply, this would be supply and resistance, gold retraces at least 1,000 pips. This retrace was 2,000 pips. And then we already had the 1,800 level drawn on our chart. 1880, that was drawn on our chart before the week began to go long. So now the 1880 has become support. And then we get trade signals at both. That's a pin bar on the 3. Those are pin bars on the 3, 5, 15. And then we can get in a trade there. So the daily range allows you to, with a degree of predictability, say that this price has moved 3,000 pips. We go back to our data, price has not moved over 4,000 pips, but in the last 3 to 4 days, price has only moved 2,000, 1,500, 1,300. Now this day on the 12th is exceeding these average days. The longest day that we had in pips was 4,000 over here. Then we have a 2826 over here. So then during the trading day, when we see this pip range entering into the 25 3000 range, then what should we be thinking? We should be planning our trades based off of supply and demand area. Now we're in an uptrend. If we were in a downtrend, it would be the same theory. When we're in a downtrend, we're just entering into a area of demand and an area of support, as it did right here. So our first trade signal for the New York session for a daily range that is an uptrend, that's entering pips above 3,000, entering pips above 3,000. So the day starts off at 0. And now the Asian session has come in. The day is pushed up 1,000. Now the London session has come in. The day is pushed up 1,500. Now we have a new spike in the New York session, and the day has pushed up almost past 2,500 to 2,600, 2,800, because that was actually 2,800. So from the start of the day, from the Asian session, now the day has pushed up past 2,500 to almost 3,000. But what do we have here? We have an area of an institutional 0-0. We have a strong monthly area of resistance. Do you see all these monthly highs right here? We have monthly highs, monthly lows, monthly opens, and monthly closes. And this area now has become resistance once price reaches this area again. But we already have had that drawn on our chart. So how does knowing your daily ranges and using data every day in your trading day, pull up your data sheet. Before you begin your trading day, pull up your data sheet and review your daily data, your daily range. So now you have an advantage going into the London, going into the New York session, where usually you're going to get the daily moves. Sometimes during the Asian session, you'll get a daily move that's around 2,500. Most of the time, you're going to get your daily moves with the open of London, the Asia-London overlap, and the New York-London overlap. And that's just due to the volume of institutions that start entering the trades during that time. So now you have an advantage for knowing your daily ranges when price is entering into a higher end range based on the data. Then you can start planning your trades when the trades line up with pre-drawn supply, demand, support, resistance, order blocks. Now again, understand that all markets, the stock market, the food market, commodities, corn, oil, gold, the only cause of movement in any market is supply and demand. The only cause of movement in any market is supply and demand. So again, I could have all squiggly lines on my chart, but if there is no supply order here in the market, then the price will not go down. Now, when there are more sell orders in this area in the market, then the price will go down. That is how powerful understanding market moves, how institutions move market, is solely based on supply and demand order blocks. When you go to the stock market, you see the stock market pits. There are individuals placing orders to move the market, orders to buy, orders to sell. It's that simple. Supply, demand. So when you grasp the supply and demand and how powerful these numbers, the 00s, 50s, and understanding where the supply and demand is in the market timing, then you are going to become a very, very profitable trader. And then we want you to go bless somebody. Go teach somebody else so that your community, mom, dad, you can meet your financial goals, and then give to your communities. All right, so this is the first video on the daily range. We're going to do probably a couple of more videos on the daily range, just so you can see some examples of how to use this data every day when you start trading. Daily range data will give you a huge advantage and confidence when you're coming into having to make a trade decision at these pre-dawn supply and demand support resistance levels. All right, see you in the next video.